I should have put that audio down. Hello.
I'm like, is that me? Because normally it's me. I was like,
Right.
I'm looking for my phone, like, oh, I didn't turn my volume off. That's all good.
Oh, no, tonight is my special night.
It's all good.
Um, I just want to first say thank you to everyone who's joining in. I see uh, YouTube, Facebook,
LinkedIn's on
LinkedIn.
here.
All right. Good. Good to see it. Good to see it. I'm trying to get on so I can just see.
Hey, 1 minute. Well, hi, sweetheart.
Hi.
Let's do it.
Okay.
Let's get in here.
All right. Okay. Here we go. Here we go. I got it now. All right. So tonight we're going to be talking about IULs. We saw this video, and I think it's kind of fun to take these videos because there's so much content out there. It's like, how do you know what you're looking at? What is it that you're looking at? And who do you know
Guess
to.
who's frozen?
Oh, dang it. This is like a game now. Like, how long? Maybe we should just like make this a betting situation. I don't know. Is that legal? Can we gamble? Uh, let's take bets on how long Donnell's camera is going to last before he freezes. Well, anywho, while he's doing that, let's get in here. I don't have a game for tonight, but really the game is that we're all scrolling through this social media kind of like slot machine, right? And we don't know what we're looking at. I think from my perspective, it was really difficult, especially when I was just first learning about these types of vehicles, and Donnell was explaining it to me, so I can share from that perspective at least. And as I was seeing all this other content out there, and I was going, well, gosh, how come their stuff is so different, right? Or how come, or why is it this way? And I think understanding the why, like why particular things look or why people would say particular things, for instance, the video that we're about to share with you, is important. Like, why would this person be wholeheartedly believing in what it is that they do? Now, Donnell's, you wanted to make it very clear that you are not out here to call other people's babies ugly.
Right. I mean, look, a lot of these people that I follow, a lot of the people that we share on this channel are people that I follow, and I follow them for a reason because the what they're communicating makes sense. They're educating me, and I'm but the issue isn't them. Sometimes the issue is just the tool that's being used isn't as effective.
Yeah.
And again, I'm sharing people that I follow, that I actually pay attention to and watch what it is they're doing. But imagine how many people out there who are not brave enough to be on social media, and what type of products are they pushing?
Yeah.
Like, it's kind of scary when you think about it, right? So, but yes, I'm not here to call anyone's baby ugly. What I am here to do is show you the difference between what you might think is efficient compared to something that might be a bit more efficient for you.
Yeah. Okay. So that's Donnell's initiative. And I love that about you. I'm not here to necessarily call people's babies ugly either. What I am wanting to do though is the most important thing for me, which was exposing why these aren't just options out there. I think that a lot of people, including me when I was learning, just consider that these are just all the different options out there.
Right.
But there's a truth to what these options actually mean. And if your goal really is to do the best that you can with what it is that you have, then you have to understand where these options will and will not serve you. Then you'll understand who you're getting the advice from. So,
Very
by
true.
the way, I just want to say this though. You said we follow people. No, we do not follow somebody like that girl video that we showed, and she was like smacking and eating the whole time. We don't follow people who eat and talk in their videos. Don't do that. It's gross. Why? Ugh. Why did she do that?
She's living rent free in your head, isn't she?
Rent free. Yes. Like it would just happen to be loaded in here last time. So when I pulled it up today and While she was talking, and I'm going, girl, I would have really just dove into the information you wanted to share because she was so passionate. Just put the salad down, just put the
Right.
lunch down, and get the 1 minute video out the way without all of that. Okay,
Agreed. Agreed.
let's just get this live stream out the way without my antics and ranting about that video. Just don't eat. I'm not eating on the live stream, smacking in front of everybody. Nobody wants to hear that. Ew. Okay, moving on. Let's get into the video. So now we have this thing. Now you're gonna have to tell me if it's on. Just give me like a thumbs up because
Not a
I
problem.
can't hear it because
Let's
of
do it.
whatever the loop back issue is. Okay.
Let's do it.
All right, here we go. Well, they probably learned that I have sound triggers. That's probably what they learned today. Okay. So do you want to give them a heads up or
Yes,
just get
that's
into
what I'm
it?
going to say. So, this video is really about a gentleman who provides IULs. He's a life insurance provider, and he's going to walk you through what it would look like for someone 50 years or older to be able to have an IUL. And here's what we know about cash value life insurance products, secure compound interest accounts for people who are my age or
I was
older.
gonna
I know
say.
you were. I beat you to it. Here's what we know. We know that we don't have as many compound cycles as, say, our 20-year-olds, right? And ultimately, what that means is we can either give a large amount of money a short period of time to be able to compound, or we have to be modest about our money, but give it longer time to be able to produce the income that we want. Compared to our children, they can put away $200 a month. I said I wasn't going to call them children anymore. Compared to our children, you can put away $200 a month. And by age 55, 58, they would still be a millionaire and still be able to retire. Whereas someone my age can't do that. So he's going to walk through what it would look like for a 50-year-old to have a secure compound interest account like an IUL and what would happen.
Yeah. And if you guys could put in the chat maybe what we could call them, because I don't want to call them offspring, adult offspring. Like, what do you call them when they turn adults? They're still your kids, right? But what do you call them? Let's come up with another thing. Put it in
This
the
dude,
comments. These blanks.
man. Okay.
Okay.
Anyway, let's
Yeah.
jump into it before we go down a rabbit hole here.
All right, hold on. Here we go.
All right.
If you are 50 or over, let's talk about it. Absolutely, an IUL works if you're 50 or older on two conditions. One, it has to be designed appropriately, and two, it has to be funded appropriately. In order to design it properly, you want to minimize the death benefit in order to maximize the cash value. You also want it funded properly. The more money you put in, the bigger and faster you see the benefit of the compound interest. Here's an example of a 50-year-old saving $500 a month for 15 years, $1,000 a month for 15 years, and $1,500 a month for 15 years. So if you have a 50-year-old female putting aside $500 a month starting at age 50, that's $6,000 a year, and then at age 65 you turn on an income stream of $8,300 per year. Now if we take that same 50-year-old female and put $1,000 a month, that's $12,000 a year for 15 years. At age 65 you could turn on an income stream of $16,000 a year for the rest of your life tax-free. Now that same 50-year-old female putting $1,500 a month aside, that's $18,000 a year for 15 years. You could turn on an income stream of $25,000 a year for the rest of your life tax-free. Now let's say that same 50-year-old female put aside $1,500 a month, but instead of 15 years she put it aside for 22 years, retired at age 72. Now it is a $50,000 a year tax-free pension as long as she lives. So if you contribute for a longer period, you're going to obviously have more growth at the end. Lastly, the biggest advantage to the indexed universal life is that you can access your money tax-free, and you can be assured that if you turn on the lifetime income benefit rider, you could be guaranteed to not run out of money. If you are ready to implement an indexed universal life insurance policy for yourself, send me a DM or comment.
Okay. So, something key that he said at the very end there that I think is important, which is turning on whatever the writer is. And if you don't even know that language to be able to communicate that or ask, like, does my policy have the writer? He is correct about if it's structured properly. And that's what you're going to talk about today.
Absolutely. I'm going to say the words he used were the right words. Is your policy structured properly? Is it a max funded option B policy? Max funded saying we're purchasing the least amount of life insurance legally possible. Well, if we're purchasing the least amount of life insurance legally possible, how does that help you? Well, that helps you because the more life insurance you buy, the more expense to you. So if you're buying less life insurance, that means this product is less expensive. And if it's less expensive, that means there's more money available to you to actually start being able to produce income. So max funded is absolutely correct. Option B, all he's basically saying there is as you contribute to your IUL, the death benefit should be increasing based off the growth of cash value. What does that mean in English? Well, the more cash value you have, the more income available to you to be able to produce income. So he's correct about that as well. So I think the words used is correct. Now he went very, very fast in the example. So we've taken the time to kind of slow this down a little bit and take a few screenshots, and I'll kind of break down in a high level fashion as to what the criteria is actually saying. So,
Yeah. Okay.
right.
So let's get into that.
Let's do it.
And actually, you're just going to go on both sides, right? You need the full screen.
I do, but I think we can kind of play with it too. I'll let you, as the great editor that you are, or producer that you are, or wife that you are,
Which one do you want to start with? Which side do you want to start with?
start with the slide side. I can't
The
remember what
vibe
it's called.
side.
Yeah,
Okay.
vibe side. We're vibing on that side.
Vibe side.
Vibe side. All right. So again, just trying to highlight what was said because things were said pretty quickly. What we're talking about here is a 50-year-old. Hold on, let me see where I am. Yep. What we're talking about here is a 50-year-old putting away $500 a month. That is not a lot of money. $500 a month, $6,000 a year over the next 15 years. So in total, it would have put in about 90,000. Oh, did not want to do that. In total would have put in about $90,000 over that 15-year period. And the idea behind that is if you were to do that, that $500 a month, $6,000 a year would produce for you about $8,382 annually. That is not a lot of money if you're looking to be able to retire around that year 65. I think what I love about this is I get a lot of calls from people around my age who go, hey, I really want six figures of income when it's time for me to, retire around that age 62, 65, whatever that is. And I say, okay, no problem. What would you like to contribute if your goal is to be able to achieve a six-figure income? And they say $500 a month. Well, okay, and then I just step back and I go, well, let's do that math. $500 a month, $6,000 a year over the next 15 years, that's a total of 90,000. What vehicle are you hoping to be able to contribute to that's going to produce you six figures in income based off you putting away 90 grand? Like this is not magic, right? This is compound interest. It's not sexy, as I like to say, and it also moves slowly. So
Wait.
yes,
You're not a
yes,
magician?
yes. I am not a magician. I wish I was though.
I wish I had a great line right now. Could be like, "You're magic. You seem
So
magic to me."
in addition, the second item that he talked about was putting away $1,000 a year over the same period of time, which is $12,000 annually. And over that time frame, you would have put away about 180,000, and that 180,000 would have produced right around 16,000 a year annually. Again, that's much better than the original $500 a month, right? But $16,877 annually still isn't a significant amount of money. So
A
again, what
year.
that's what did I say?
No, I'm just reiterating
Oh
that
yeah, yeah.
$16,000 a year is not income.
Right, absolutely. But still, $1,000 a month is significant. That's a significant amount of money. So what should you do? Should you give your money more time, maybe? So, and then the next one, he said, okay, well, maybe 1,500. What about 1,500 over that same period of time? Okay, $1,500 a month over that same 15-year period. We're talking about 270,000 in over that 15-year period, and you would achieve about a $25,000 annual income, and that's tax free, by the way.
Yeah.
$25,000 tax free income, awesome. But over that 15-year period, $1,500 a month is 270,000. Should 270,000 be accumulating a little bit more than 25,000? It's like if you were to do that math and break down, okay, what have I spent over time, and what is that growth over time? That's where we look at the structure of the policy. And one of the one of my favorite questions to ask clients is when you're looking at your IUL, you're looking at your whole life policy, when you're looking at the illustration that was provided to you, ask this question. At what point, when I put in $1, do I have $1 working for me?
Yeah.
So if I put in $1 in year one, or in this case, if I put in $1,500 a month, $18,000 a year, at what point do I have $18,000 working for me? Well, over 10 years, that's $180,000. Do I have $180,000 working for me in 10 years? And in digging into some of the details of these policies, and again, it's kind of hard to see here. I just want to highlight, we were able to kind of identify where some of these break even points were. What I learned about these policies are they're actually designed fairly well, meaning the break even point is right around year, I'll call it 8, 9, 10. And I would say for an IUL, that's pretty good. It's not great, but it's pretty good. And all I'm saying there is the break-even point is fairly effective, which means these IULs were structured fairly appropriately. And now the last piece, putting away $1,500 a month, but extending that time frame from 15 years to more like 22. And again, giving a modest amount of money, a longer period of time, produces more income. So in this case, that $1,500 a month over a 22-year period instead of 15 produces about $50,814 annually, and you would have put in during that time frame almost $400,000. So again, this income is a little bit better. My argument is this: is there a product out there that can do better than this? There is a lot of people on social media screaming IULs. And they're screaming, watch who you're getting your IUL from, make sure it's properly structured, make sure it's max funded, all of the right words. Is there a vehicle out there that can do better? And my argument is yes. And that vehicle would look like a secure compound interest account in the form of a premium finance strategy called MPI, maximum premium indexing. So what we did was kind of built a little table to kind of use. And I know this is a bit small to see. I just wanted you to see the columns first.
No, it's not all on the screen. You got to move it, like shrink it down. Can you see how much? Okay, there it is.
There we go. My bad. All right. So we're talking in IUL. So the in this example, the $500 a month was buying a certain amount of life insurance. That life insurance was about $101,000. So again, if on a max funded policy, we're purchasing the least amount of life insurance legally possible. So $500 a month, buying about $101,000. $1,000 a month, buying about $203,000. And $1,500 a month, buying about $307,000, whether that's 65 months or 72 months. I mean, till age 65 or till age 72, it's still right around $307,000 in life insurance is the initial life insurance amount. And again, based off the total contributions, this is that annual income coming from the IUL. What I want to do is take these exact same numbers, doing an apples to apples comparison of what this would look like inside of an MPI strategy, a maximum a premium finance strategy versus an IUL, because MPI is built, the foundation of it is built on an IUL. So meaning the process is similar, but the functions are different. How income is produced inside of MPI is different. And that's what kind of is going to make these numbers drastically different as well. So if we do the side by side, so I can jump into the calculator. Yep. So, I was playing with this earlier before we started. So let's start here. So 50 years old, allowing this to compound till age 65 and putting in $500 a month. What would that do inside of MPI? Well, just highlight it real quick. Again, $500 a month would produce for you right around $19,000 in tax-free income for life. $19,000 compared to $8,382. So, and just to kind of break this down a little bit, over that, it's the same $90,000 that was put in over that 15-year period. Notice the difference in accumulated value. And how do we get from this accumulated value based off the $90,000 that was contributed. Well, there's a certain amount of leverage that was used inside of this policy. That leverage was right around 342,000 over that time period. So you're making around 7% on average on the money you've contributed, and you're making around 3% on average. And I'll get into some of these details as to how. 3% on average on this 342,000. 3% on this dollar amount plus 7% on this dollar amount is what gives you this cash value of 161,000. And it's that 161,000. This 161,000 is how this 19,000 in tax-free income is able to be taken. So again, if I was to come over here to the other side, that's 19. Let's make this a little bit thicker. That's 19,000 in annual income compared to 83,842 inside of a traditional IUL. So at a minimum, MPI would double the amount of income available to you over the same period of time using the exact same dollar amount. But one other thing I want to highlight though is what would this be compared to a traditional retirement account? So let's say you didn't have an IUL. Let's say you put that same $500 in a 401k, same $500 a month. Notice the difference in an accumulation value. A 401k would actually have more money in it than an MPI strategy, and also compared to an IUL. But look at the difference in income. The difference in income compared for MPI compared to 401k, that's a significant difference in income. We're talking about $7,000 to $8,000. But I would say it's also comparable to an IRA. What's that, $77.94?
Yep.
And this is if we were to look at a 401k. So I want to also highlight these values as well. So again, putting away $500 a month, regardless of whether it's an IUL, an MPI plan, or 401k, the difference in income, MPI is still 2 times that on average. So, okay, what does it look like if we were to make an adjustment to the contribution amount? So instead of $500 a month, let's look at $1,000 a month. $1,000 a month over, again, the same time frame. You would have put in the same $180,000, whether we're talking about an IUL or MPI, the same $180,000. The difference is the amount of projected cash value available to you. That's $323,000, and that's based off the, again, 7% growth on your 180 plus 3% growth of your 685 is what it gives you, this $323,000 in cash value available. And if you look at the correlation between these two numbers, this 38,400 is based off this growth. So it's 38,400 inside of MPI compared to $15,588 inside of a 401k. And again, look at the comparable amounts. I'd say the growth inside both are very similar. 323,000 compared to 389. So we're talking 384,000. I'm sorry, 384. 34,000. 38,000, my bad. 38,000 compared to 15,500. Uh-oh.
And the IUL illustration that he showed was 16,000, right?
Right. 16,877. Thank you for that. 16,877 for 16,877 for an IUL, putting in $1,000 a month annually would produce around $16,877,000 annually compared to 38,000 inside of MPI and compared to 15,000 inside of a 401k. So again, the amounts are comparable. Now, the difference between a traditional retirement account compared to MPI or compared to an IUL is one of those you have to pay taxes on. The money coming from your 401k, your traditional 401k, you're still going to be taxed on that $15,500 in income. So again, a huge difference is we're talking tax-free growth compared to taxable growth, but still the accumulation value, the dollar amounts in IUL compared to a 401k are very, very close, very similar.
And you don't know what the tax rate will be
right
at that time.
Absolutely. You're giving yourself you're writing a check for the future. Right, you're giving the IRS the opportunity to charge you whatever the tax rate is in the future when you start taking those distributions. So you're absolutely correct. And so when we look at same age, putting away $1,500 a year, $1,500 a year inside of MPI, it's the same, again, it's the exact same 270,000 over time, but you're able to produce about 57,600 in income. And if you compare that to a 401k, it's roughly half that, about 23,000. And so using those same dollar amounts, 57.6 and 23.3. And again, we're talking about double the amount of income compared to a traditional IUL and compared to a 401k. Double. And then the last one was, and I appreciate him using this example. The last one was, hey, acknowledging that, hey, as a 50-year-old and you're wanting the income that you can actually be able to live off, what if you gave your money more time? And that is the truth. As someone who may be considering themselves starting a little bit late, in order to achieve a livable income, you might have to give your money more time to be able to compound. And so the thought process there was, okay, what if we take the same approach, but instead of age 65, we allow this money to compound till age 72. So $1,500 being able to compound from age 50 to age 72, we're talking $126,000 tax-free for the rest of your life. All because you gave your money a few more years to compound. Because you gave your money a few more years to compound, you're now able to take $126,000 tax-free for the rest of your life. You would have put in $396,000. You would have leveraged about 2.2 from the life insurance company, which would have produced cash value for you of about $1 million. And notice, you actually have more in your 401k than you do inside of your secure compound interest account, also known as MPI. So you have more net worth, but look at the difference in income. We're talking 46,000 compared to 126,000.
Well, you're talking about 4%.
Right. This income from this 1.1 million, or regardless of what the dollar amount is sitting here, is based off the 4% rule, meaning the max you can take as a distribution on an annual basis. And this isn't a rule that I made up. If you were to Google the Trinity study, you would find that the 4% rule is identified as the amount that you can take on an annual basis so that you don't run out of money. And it's a standard that the majority of financial institutions use. If you were to put this same dollar amount inside of the Vanguard calculator, this is exactly what you would see. You would see approximately 4% of whatever that nest egg is being the income that you could take on an annual basis. So again, this 126,000 inside of an MPI plan compared to 46,000 inside of a 401k. And again, I go back to the gentleman's video. I agree with the wording around it has to be a max funded option B policy. He is correct on the type of strategy required in order for you to be able to produce income. The issue is the vehicle being used. The vehicle being used in this case, there's a drastic difference between the growth inside of an IUL compared to the growth inside of a secure compound interest account, also known as MPI. It's a significant, and it's not even close. Which would you prefer? Would you prefer $50,000 annually or $126,000 annually? Again, it's not even close. And one thing I wanted to highlight, any questions before I highlight? I have one last thought I wanted to share. Any questions about any of that?
Nope, no questions. Well, I have something that I want to point out, but I'll wait till you're done.
Okay. The only other thing I wanted to mention was this. And I'll make this a little bit small. I want to bring over something, just show you how money actually grows in an IUL compared to an MPI plan. And I know these colors are a little bit difficult to see.
Here, I can give us a different.
No, here we go.
A different screen. Because you don't need the.
Oh, let me make it smaller. Yep. So I just wanted to highlight how money grows inside of an IUL compared to MPI. And so we're using the same, we're going back to the original $500 a month. $500 a month is $6,000 a year. And I'm just looking at highlighting the first 10 years. What you see here is over that 10-year period, you would have put in $6,000 a year annually for the first 10 years. So in total, over that 10-year period, that's a total of $60,000. Well, the way growth works inside of an IUL, now IULs are different depending on where you get them, but that growth on average, if you're using the S&P 500 index, is around 7% on average. Now, there's some IULs that are capped, uncapped, using different index funds, like the variables can be different. But if we were to compare apples to apples, using an IUL that's using the S&P 500 for their index call option, and on average, that growth is right around 7%. So if we compare apples to apples, that's $60,000 growing on average, 7%. The difference between an IUL and MPI is leverage. Starting in year 3 inside of an MPI plan, starting in year 3 inside of a premium finance strategy, we add leverage equal to what was contributed in year 1. So starting in year 3, you're able to add an additional $6,000 from the amount that was accumulated in year 1. So if you put in $6,000 in year 1, at year 3, you're able to take that amount, leverage that amount from the life insurance company's money, and add that to your accumulated value. So in essence, you've put in $18,000 over the first 3 years, but because you've added an additional $6,000 from the life insurance company, it looks like you've contributed $24,000. And in year 4, you're able to do the same. But in year 5, something special happens. In year 5, you actually use leverage from years 1 and 2. Well, if you were to add years 1 and 2 together, that's $12,000. So at year 5, you're adding an additional $12,000. And then at year 7, you leverage years 1, 2, and 3. So 3 years of $6,000 is 18 grand. So at year 7, you're adding 18 grand. And then year 9, it's 4 times the first 3 years. So again, the dollar amount that you're able to leverage increases every year starting in year 3. So in essence, over that same 10-year period, instead of just $60,000 being contributed like it was in an IUL, it's actually $60,000 plus an additional $120,000 of leveraged dollars from the life insurance company. And you didn't fill out a form to be able to do this. You didn't, there was no credit check involved. There was no process other than making sure you were still healthy to make sure you could pull this leverage inside of your policy. And here's what happens. You're making 7% on your money plus 3% on this borrowed money. This process alone is what produces more income and has more, gives you more income availability than a traditional IUL. It's this growth. It's the 60,000 you've contributed plus 3% on the 120,000 that you leverage. And that's the reason why MPI grows at such a rate faster than that associated with a traditional IUL or whole life policy in general. It's that leverage piece. And I think this is the piece, that leverage piece is the piece that most who don't understand a secure compound interest account like MPI, they don't understand how that leverage is added. And again, this is a very high level. I didn't go too far into the weeds because there should be a lot of questions around how or why. Why would a life insurance company even allow this? But it's this factor, it's this piece that makes MPI so unique.
So why wouldn't, one thing that he said at the end of his video, and I wish I could just cue it up really, really fast, but I don't want everybody to wait for that. He says, as long as you turn on, dang it, I wrote it down and now it's over there. As long as you turn on the max income producing rider, it's a rider to the policy is what he was saying. And he was saying, as long as that's turned on, then you can, then these numbers make sense. But if it's not turned on, and what you're saying is you don't have to turn on something, you don't have to make sure something's here. None of that stuff exists here. So my question is this, I'm going to go ahead and ask questions for the people because I am the people, right?
Okay.
If this is what it is and this difference is so drastic, why even bother with an IUL? Why wouldn't everybody just be talking about MPI?
Well, I think one of the largest pieces of that is just simply advertising. You don't know what you don't know. And if anyone's following me, if you're scrolling through your feed and you're getting hit with videos from me, I would bet you're getting hit three times, if not four times, the videos associated with IULs, infinite banking, and whole life policies. So I think that's one of the pieces is people don't know what they don't know. And when you dig into the detail, you don't find this out until you actually dig into the details. So I think that's one of the largest pieces. But the other one is you mentioned turning on the income rider. Let's just call it that. Turning on
Yeah.
the income rider. Without having the illustration physically in my hand, I don't want to make assumptions as to what that means, but I have an idea. Most IULs are structured or designed to produce income. Well, it's going to continue building cash value over time until you decide, hey, now I want to start taking income. So if that's, just turning on the lever to start achieving income and those, and that process start taking place inside that policy, there may be an action that you have to physically do. Or it also could mean there is a rider in place that specifically is focused on producing that income for you. Rider implies fees, meaning if you're adding something additional to your policy, then that implies the fact that there may be additional fees associated with adding that rider. And again, I don't know, without having visibility into that specific policy, I can't say, but I can tell you what it looks like inside of MPI. MPI is an income advantaged IUL. And it is already structured or designed. We design these to produce income. And when you are ready, it's just a lever that you pull. Hey, by year 65, I want to be able to take income from my policy. So then that just means we turn on that lever so that income can be produced within. So something fairly simple.
Okay. Another thing that I wanted to point out, if you could just do me a solid and pull up one of those examples that have the loan amount, because he showed in his video, you can see all these columns. So, I love a good rabbit hole. So I dove in deep and I figured out because it's really hard to see. I figured out all his cells across the top, the titles of those columns. And then, so what's actually in there? I want you to just zoom in real nice and close. There it is. There it is. Here's this looks small, this particular one. You know what? Go to the 22 year. I think that one's
Yep.
Yeah. Because this is where you go, are you kidding me? What the heck is this? Okay, I can't see it, but I know what's on there. It's what's on there is the loan amount, which is you're taking a loan to get that income. That's how you explained it to me even, right?
Right. So the income comes from your cash value. And you don't withdraw income from your cash value, meaning if you just using round numbers, if you've got 500,000 and you're taking 50,000 as income, you're not withdrawing 50,000 from that cash value of $500,000, because if you were to do that, the balance on that $500,000 would be now 450. And in addition, you would end up paying taxes on any growth. So we don't withdraw money from your cash value. You actually leverage or borrow against the cash value, and that is your income. So you're borrowing 50,000, which means the 500,000 is still working for you.
Okay. Here's the weird part. This is the part that got me all heated earlier. And I was like, why are these things things? Here's what I know, because here's what I looked up. And if you're taking out a loan of $50,000 every year, by the way, and the column to the left, just look at the column to the left, scroll up so that they can see it's not cut off. There we go. This number continues to grow every year, not because it does, whatever the explanation is, this is the loan amount. Right? Why does it keep going up? So you're on year 5, you're retired year 5, you took out a loan for 50,000, but what you actually took, the actual loan amount, the income that you took was 50,000, but the actual loan amount was 60,000 something. I can't read what it says.
6829.
Yeah. $60,000 is what you're taking in a loan to get 50,000 in income. Now, here's the part that I thought, well, doesn't this make sense? Within IUL, I do think that this concept, when I learned about it, and for instance, I understood that this is a great option for people, especially because we all should be in a situation where after we've already paid our dues, we've already paid our taxes too, our income taxes. So now, and we paid taxes on the money going into a vehicle like this, you should be able to grow it tax free. No different than a Roth environment, right?
That's exactly what's happening.
Okay. However, part of the magic of the traditional retirement plans for the industry that profits the most is that they profit the most. What Frontline had done in their documentary was exposed 2/3 of retirement plans are gobbled up by fees. 2/3. And these are fees based off of how much money's going in. These are fees based off of if you want to be able to take all of your 401k accounts that you have and you want to invest them here, I'll give you a kickback. But that kickback isn't taken out of that amount. It's charged back to the person, right? So it's not even taken out like a commission on the deal. It's just a fee added to the end user. Not fair, not cool. But this stuff is legal. This type of stuff is where I go, these are the weeds, and I understand, we're not going to get in the weeds. Plus, this guy is not here to defend himself or how this policy is designed or what exactly these numbers mean. But this is a red flag for me because if you are leveraging $50,000 every year, but you're taking out a loan at $60,000, this sounds like fees.
Well, and then that's just it. There are fees, meaning when you say the loan in general, just the word loan alone is saying, hey, I'm going to borrow this money at some cost. And I think what you're seeing there is the cost of borrow. So I'm going to borrow this $50,000, use it as income, which means it costs me maybe 4% or 5% or whatever that interest rate is. I know inside of maximum premium indexing, that cost to borrow is 4%. But here's
4%
why
on
you don't
what
have
though?
4% on the dollar amount that you borrow. So if it's,
This isn't 4%. That's what I'm saying though, is
but
that
hold
this,
on, you have the prior year, right? So it's 4% on the year prior. And then that gets, if you don't pay it back, that gets additive.
the math ain't mathin' for me. I don't see how a $50,000 loan in year 5, if it's increasing a 3,000 to something per year, let's call it $2,500. It's increasing by $2,500 every year.
And again, that's where the structure matters. But here's the piece that I think gets lost.
Okay.
Regardless of the cost to borrow, if you're making enough money inside your policy to pay for whatever that cost to borrow is, none of it matters.
Sure.
Meaning, if I am taking a distribution of $50,000, but it cost me, let's just say, $60,000 to borrow it, but my cash value is making $70,000. I got my income, I paid for my cost to borrow, and my account is still making money. That's the key. And in most traditional IULs or MPI policies, that is the opposite of what's occurring. I'm taking an income, there's a cost to borrow, but the growth inside my policy isn't paying for the cost to borrow, which means now I'm eating into my cash value. And as a result, my cash value is getting smaller. And if I don't pay attention, my policy might start to eat itself. That's the scary part.
Right.
And that's where structure matters. Structure 100% matters.
Okay, can you scroll up to the $8,000 a year,
50-year-old.
50 years old with the best plan that they could get is 8,000 with some of these options, which is not, this still should not be an option, let's just be honest. But here's my point. You only have $8,000 a year that you can leverage from this plan.
Right. You can take an income. You've put in $500 a month over the last 15 years. You've put in 90 grand.
Okay, what does the number say after at the bottom where the loans are? What's that like year 5 number? You're taking 8,000 in income, but you're Your loan amount is what? I
It's
can't
about
see
a,
it.
yeah, it's about, oh, it's about 90 in year five, about $10,000, 10,034.
See, it's the same. It's increasing for whatever the reason is, but how does this not eat up your fees? And that's my point, is that you got to know the questions, because if you're not looking at this, you're not aware of how the fees are structured, regardless of the product. That's the part. And the only reason why I'm so passionately ranting about it is because it is unfair to people who are putting their time and their hard earned money into these vehicles. Some of them had no idea how to build uh, any type of security for themselves. And so somebody who only, maybe they are 50, like you right now. Well, and maybe they maybe they can only do $500. So this $8,000 makes a difference. If
Absolutely.
if you're also heading in the opposite direction to eat away at this policy, you are not creating generational wealth, and all you're doing is creating this supplement. It's not even enough to live off of, right?
Right. And again, $500 a month is significant.
Yeah.
If $500 a month is what you're capable of putting into to your policy, and you let that compound over 15 years, $8,000 compared to $19,000 is significant.
Yeah.
Right. And
Yeah.
then you add, Social Security or whatever other retirement plans on top of that. Like that is very, very meaningful. So yes, definitely nothing to kind of scoff at. But the key is, what vehicle are you using?
Yeah, we have a couple comments.
Just do it.
Gabe, he says, ask the questions, Angelique. Thank you. I will continue to ask these questions. He said, wow, 2/3 of retirement funds are eaten up by fees. That's crazy. If you have not seen the Frontline documentary called The Retirement Gamble, go watch it. Walk, run, don't walk. And then let's have this conversation like on Sunday. We've switched the live stream, by the way. We're going to do Wednesday and Sunday to try to see if more people are able to attend. Either way, it doesn't matter to us. So we're just looking for that feedback. But go watch that so that next time maybe we can kind of go over some of that. And then he says $10,000 in fees on the 5-year loan. So the policy has to cover the loan and still grow the cash value. Good
That's the
advice.
key. That's the key. And again, the way you understand, the easiest way to find out whether a policy you have is effective or not is ask the question, when do you break even?
Yeah.
A secure compound interest account like MPI breaks even, meaning when you put $1 in, you can get $1 out. It breaks even at year 3, which
Okay.
means from year 3 forward, everything from year 3 forward is growth. Everything from year 3 forward is profit. Everything from year 3 forward is producing income for you. Most IULs, most whole life policies break even around years 7, 8, maybe 8, 9, 10, 11, somewhere in there. I'd say a really solid policy breaks even around year 8. A really poorly designed policy breaks even around years 12 or 13. And so that's the easiest way to see whether or not what you have currently is efficient or not.
Okay, there was one other factor in here, because and I hear you a lot going over people's policies because they were just given their illustration. They weren't actually told what
Right.
all the numbers and
Right. They don't know how
columns
to
are.
read their illustration. That is correct.
Yeah. So you're helping them understand what it is that they've purchased somewhere else at some other time,
Right.
right? And then when I was looking at this video from this guy, one thing that stood out to me was what happens to the accumulated value after you start taking your income. There's no possible way for your money to double or compound ever again, because now the amount of draw that's coming off, and because you don't have uh, enough of an amount up front, right? If it was able to double one more time in that time frame,
Right.
65, you could have one more you could have a significant amount of growth in 15 years of being retired. Let's say she, at least to 80, right? We would
Right.
all hope. But you should be able to know that all of these things, and that you can leverage it. The problem here is looking at the number. Will you pull it up? Because I want to point to that particular thing. It's
What are you asking me to pull up?
That column on the right, when the, I wish I could see. It's okay. Here's a great example. Just leave it there. Just leave it there. At the top, I can tell it's 200,000, right? Okay. At the bottom though, what's the number at the bottom?
About 894,000.
Okay, where that red line is where that's the amount of money, 393,000 total that you would have put in through the policy.
Right.
That's where
Over a 15-year period, you would have put in 396. This is that 396 point is what you're saying.
yeah,
Right here in this area.
396 point where that's the value at that time. Okay, cool. Where is, if you go half of that to see where your money actually doubled, so that now this is where all your money's working for you, right? Your money should be making its own money type of thing. Well, if you go down right before you start taking income, it's almost doubled, right?
Right. About $700,000.
Right. How many years is that?
15.
Okay. Just look at the column all the way up. Start going down from that point. There is no way it's going to double again in that same amount of time, or it's growing at the same rate.
Right.
And
Because
if you
you're
were to
now
just-
taking distributions.
Right. This is the 22-year-old example. Go up because there's like a longer list. Since this is starting at 22 years, let's just do the 15-year because it gives more of that illustration. Just one of them. It doesn't even matter. One that has like more, shows more of the columns. Sorry guys, I had to like really scrub through here and find clear numbers because otherwise they're blurry because he was moving it too fast.
It's about as
Okay.
much I can make it. Yep.
No, that's good. Okay. But the point is, look at what's happening to the accumulated value. And then on the other side, what's that column?
So the column, I don't know which side you're referencing, to be honest.
Oh, you know what it is? It's the, if you terminate your policy, your surrender amount or whatever. So that's on the other side. But the point is that this number here cannot grow as fast. So as fast as you're taking it out. Now, the more money you put in, the more money that's in there. So I understand that. So that's really the game, is to get as much money as you can in there so that it can start compounding. I understand that part of it.
But I think in simple terms, it's this. If you're taking a distribution of whatever that dollar amount is, and in this case, it's 16,877 annually. If you're taking more than your policy is able to produce, then what you're doing is you're putting your policy in a deficit over time. And now that doesn't mean you can't continue taking that 16,000 annually. What that means is when you pass, before your beneficiaries get the death benefit of whatever that dollar amount is, the life insurance company is going to square up how much have you taken in a distribution as income, and do you owe anything? Is this product even? Meaning, have you taken more than what's available to you? And if the answer is yes, that's where they're going to square things up, which means your death benefit to your beneficiaries would be lower.
Well,
That's how that's compensated for.
here's the question that I have about this though. And hey Sri, and Gabi, we have some questions, so hold on.
Let's do it.
He said, I'm going to watch the documentary tonight. So why do IUL policies sell more often than MPI?
So,
Well, here's the question I'm
simple.
going to tag on to there.
okay, go ahead.
Okay. Because people they've heard of IUL way more than they have heard of MPI. So that's one. But the question that I have is when you're looking at these side by side, because if anything were to happen and you were to need to leverage any of this, the available funds in this policy, let's say, well, how old is she? She's 65 when she started taking it. So let's say when she's 70, she needs there's a medical emergency. She needs to take some of the money to help pay for that. Okay. And she's not able to pay it back, of course. So this is just her leveraging her policy, which it was designed for her to be able to do. Want to make that very clear because I think that's dope that you can do that. But it's the this policy in the beginning we talked about how much was insured. It was for the $500, it was $100,000.
Right.
Okay, for this particular one, because this is the $1,000, right?
It's right around.
It was $203 that was insured.
Got it right here. Yep, 203,000.
So I just don't see how, if you have to leverage this at all, how there's really that much room before the insurance company has already made their money off of you too.
Right. Again, it goes back to design, because the life insurance company is going to get theirs. So if the policy is not designed properly or there's not enough growth inside the policy, it could hinder. And Gabe, to your question around why, I guess, why IUL seem to be more prevalent than MPI, and that's a history lesson. So MPI, maximum premium indexing, is a premium finance strategy. If you were to Google premium finance, what you would see is premium financing started in 1997. 1997 is also the same time Roth was introduced. And so life insurance companies wanted to enter the Roth arena by creating a product to allow their high income clients to be able to have tax-free growth as well. Because with an IRA, Roth IRA, if you make too much money, you're not allowed to contribute into that Roth IRA. So they wanted to create a vehicle, a vehicle that grows tax-free for their high income individuals. And they created this strategy called premium financing. Premium financing is where you get a LIRP, a life insurance retirement plan, and you use leverage from a bank, similar to the leverage that I kind of walked you through inside this example, where at year 3, you're adding another 6,000 to your policy. So you're using leverage from a bank. Well, if you're using leverage from a bank, that requires something of you. One, you have to have a good credit history. And specifically as it relates to premium financing, you have to have a net worth of up to right around $5 million. So there's not a lot of people who qualify for a premium finance strategy. And when the gentleman that created MPI, Curtis Ray, when he created MPI, he was offered a premium finance strategy from his brother, who happened to be a life insurance provider. And in the process of receiving that premium finance strategy, he asked a very simple question. Why didn't his brother have one too? Because adding leverage inside of your policy, creating an opportunity for arbitrage and growing the cash value inside your policy exponentially is so amazing. Why isn't everyone doing it? Well, again, you have to meet a certain criteria in order for you to even have something like this. Well, it turns out if you structure an IUL properly and you use leverage from your previous performance inside your own policy, you actually don't need the bank support. You can actually use the growth inside of your policy, leverage from the life insurance company to create your own arbitrage situation. So that was created around 2014. It actually became public in 2017. So what we're talking about is this just became optional for people like you and I. And again, I'm assuming you don't have $5 million in net worth. I know I don't. This just became available for people like you and I in 2017. So that's the newness part. But the strategy itself has been around since 1997. That's not new. It's just we just now became able to qualify for a product like this. So that's the reason why. And I always use the term, it's advertising. You don't know what you don't know, and who benefits from you not knowing, right? Who makes money off you from you not knowing about this?
Well, that's part of my question is why wouldn't, now that more people do know about it, specifically life insurance agents, why wouldn't they be offering MPI and talking more about it?
That's a trick bag, right? Because I'm not going to say that all life insurance providers are only out for self. I'm not going to say that. But what is it required of the life insurance provider in order for you to be able to have a product like premium finance strategy like MPI? What's required of you? Well, it has to be a max funded option B policy. Max funded is saying we're purchasing the least amount of life insurance. Let's peel back what that ultimately means. That means it has to be a product designed with the least amount of fees. Okay, so how do you design a life insurance product with the least amount of fees? You have to be willing to take less commission. You have to be willing to make less money so that the people that you're providing this product to can achieve secure compound interest. If you're not willing to take less money, if you're not willing to eat into your commission to be able to properly structure a policy, then you're probably not going to provide a product like this. What makes me a little bit different than most people who provide life insurance is I didn't come into this space as a life insurance guy. I came into this space as a retirement planner. I have a fiduciary responsibility. And what that means is I am focused on producing you income. It is not about how much I make. It is not about how much a life insurance company makes. It's about how much you make as the individual that I'm working with. How much income, would I do anything for you that I wouldn't do for myself? That is my fiduciary responsibility. And so therefore, it is not about a commission for me. It's about, is this structured properly to produce the maximum amount of income? And that's what it's required. That is required of the whoever you see providing MPI. What's required of them is they are designing this such that it is solely focused on producing the maximum amount of income for you.
Yeah, that's a great answer. He says, so wow, I wish we could pull in 10 comments. We can't, so I'm just going to read them off. So leveraging an IUL and bypassing the banks to get an MPI is genius. It's a game changer. I think that's really the truth is what I can see is this is generational wealth. This is how wealth is created by leveraging systems.
I love the fact that you mentioned generational wealth. Notice, we're talking about a life insurance product. We've spent an hour talking about a life insurance product. But how many times did you hear me mention the life insurance? Right? I've been focused on income because that's my goal here. My goal is to produce income. But when you dig into the details of the life insurance piece itself, we are absolutely talking about generational wealth. How that's structured matters as well. Meaning, most people who get a premium finance strategy like MPI, most people, the beneficiary is a spouse, maybe a kid. But when you start looking at, $500,000, multi-million dollar policies, what you really want to do is structure it such that it's feeding a trust. Like that's a whole nother conversation for us to have around this product. Because when the beneficiary and the owner of something like an MPI plan or MPI strategy is owned by a trust, now you get to dictate how income is distributed for the next 500 years. Like we are literally talking about generational wealth. And again, I spend very little talking about life insurance because my main focus is income. But when you start digging into the details of what this product actually offers, it's pretty amazing.
Is there anything you want to show to compare what that looks like, or did you already do that?
Yeah, so I think the truth of it is because we're at the hour and I don't want to belabor the point. I think what we can do is spend a little bit more time next week digging into some of the hows and details around that as well. But I think the moral of the story is a max funded option B policy is designed with the least amount of life insurance legally possible. But as you start contributing, that cash value increases, which means it starts to multiply, which causes the cash value inside the policy to multiply, which means the death benefit is two numbers. The death benefit, when you pass, there are two numbers that goes to your beneficiaries. It's the life insurance that you originally purchased, plus the cash value or the growth that you ended up not using while you were alive. And it's those $2 amounts is, again, what creates that generational wealth.
Yeah. And speaking of generations, we're still looking for what the heck to call our kids because we're not supposed to call them kids when they're adults. We need a new word. I don't want to call them offspring. Donnell doesn't want to call them MFers or whatever. Like, whatever.
At least not on the live, I don't.
The point is, whatever the phrase is that you use when you go, my kids, we have terms that's like my loves, right? And I'm feeling very endearing. And then there's like
these dudes.
But you can't, they're not all exchangeable.
Right.
They're not exchangeable. So we need a new word and what to call adult children. They said don't call them children either though, right? This is like a video that's going around on whatever social media, and it was like, can we normalize what they say? they said, can you normalize not calling adult
Right.
kids?
Right. Then
And
what
then
you
they
call
didn't
them.
say what to call them.
Right. They didn't
Yeah.
give you an answer. That's standard social media, right? We're going to tell you something not to do, but not tell you how to do it, how to
Yeah.
make it better.
We need to have a, but that's the point, is that we're creating generational wealth, and these systems is the key. Those are really the keys. We were talking about that earlier in Clubhouse. He says, okay, this is legit high quality financial information, and I'm sure this is understood in the wealthier communities. Yeah, because these people have access to these conversations all the time.
What I love about products like this, um, I have some of my best conversations with people who are not wealthy by any stretch of the imagination. Some of my favorite conversations are with 20, 19-year olds who, just started working. They decided not to go to college, so they're making 22, 25, $28,000 a year, and their main objective is just to create a vehicle that would allow them to not have to work for the rest of their life. Their main goal is not a number. Their main goal is, I don't want to do what I see my father doing. I don't want to
Right.
be in this job 40 years. I want to get to a point where 10, 15, 20, 35 years down the road, I have a choice. I get to decide if I'm going to continue working, it's because I choose to, not because I have to. And again, a 19-year-old making $30,000 a year, putting away $200 a month, which is 2,400 over a year's time, putting him in a position to have a $75,000 tax-free income by age 48, like, it's game over. That to me is more powerful than this example of a 50-year-old putting away $1,500 a month. Again, show me the financial advisors that's working with 15, 19, 22, 21-year olds who have very little to work with, but you're putting them in a position to be able to produce generational wealth at some point.
Yeah.
Most financial advisors won't take you unless you have your asset, your net worth is $100,000 or more.
Right. He said, call them cash flow deterrents. That's pretty good. No,
I actually
I
like
think
that.
this is wonderful. One of the stories, and I'll leave it here, because I think this
Flow
50-year-old
deterrence.
example, I think this 50-year-old example that was used in this video is significant for an example that you've heard recently,
Mm-hmm.
which is a guy who works with his father, and you said that he was afraid that his dad was gonna.
Yes. So he works in construction. His dad works in construction. And again, he's 20 something, 21, 22, something very early in the 20s. I don't remember really the exact age. But he was fairly upset when we were talking. I asked him what it was his goal. And he got emotional when I just simply asked him, what is your goal? And he started talking about his dad. He loves his dad. He works side by side with his dad. And his fear is that he's going to watch his dad fall into a hole and pass away on the job. And his main goal is just to not end up like his father. What does he need to do to not end up like his father? He said, hey, I live at home. I make a decent income. I make enough for me, but I'm absolutely in a position to be able to put a portion of that income away. And I use the words 10%. Hey, you make 20 plus $1,000 a year, you put away 10% of your income, which again is right around $200 a month, you're golden. And he goes, no, I live at home. Can I put away 25%? Hell, I'm willing to go up to 30%. He was eager to be able to put himself in a position so that by age 35, 40, 45 years old, he has a choice, because he felt as though his dad did not have a choice.
And also, I think a lot of people are realizing that because their parents don't have choices, that they have to create an option for them.
Right.
Because if you can't support yourself, imagine when your parent ends up needing your support
Right.
and your help. And I think at this point in 2023, it is no longer negotiable for people to be just for this situation to be laid upon them. And they're saying, if we have options, and we've seen this happen, we've seen our grandparents do this to our parents because they were in a situation, or they ran out of money, right?
Mm-hmm.
Or their pension turned out to not be enough because of inflation, because of medical costs rising, which should just be regulated, but it's not. And we don't have control over these things. What we do have is we can have control over creating a plan, and we can do our absolute best to make sure that we are taken care of and that we have our own backs. We can't rely on a government or any other type of program or system to be thinking of us and our welfare and putting us first. We
Right.
have to do that.
And what's required of you. Like, one of the things I also try to stress when I'm meeting with people is making sure they understand their role in this process. Because, like, for instance, using the calculator, I speak of all the great and wonderful things associated with putting money away and the income that you're able to achieve. But what's truly required of you to do that? Well, it's a couple things, because again, this is not Bitcoin. You can throw some money in a thing and it magically turns into something special. There is something required of you. The first thing that's required of you is you have to be healthy. You have to qualify for a product like this. And so you do have to be healthy and you have to remain healthy. So the biggest piece for you is, when you jumping into any type of life insurance based product, the life insurance company is basing that on your health. So the first step is you have to be healthy. The second step is it requires a commitment. This is not get rich quick. You need to give your money time. And so whether that's a small amount of money, a long period of time, or a modest amount of money, a shorter period of time, you still have to give your money time. And if this 50-year-old example doesn't say anything else, hopefully it says this. You have to be realistic about what that dollar amount is. So whether that's 5% of your income, 10% of your income, 20% of your income, and in some cases, 30% of your income. And then the last piece is, when should you start? Should you wait till you've paid off your bills? Should you wait till the mortgage has been paid off? Think about what you're doing to yourself when you do that. Let's take the 30-year mortgage. I'm going to wait 30 years to pay off my house. Or let's say you pay it off in 15. I'm going to wait 15 years to pay off my home before I start my secure compound interest account. How many compound cycles did you lose because you waited 15 years? Now, your argument's going to be, but now I can put more money in. Right. But you still have 3, 4, 5 less compound cycles. I would much rather take that modest amount 15 years prior, start that secure compound interest account, and then when you still pay your home off in 15 years, now you can dump even more. But you've got a machine that's already running, that's already building income for you, and now you're just adding more income to it to be able to produce more. My point to that is, start today. It's not a year from now. It's not when I pay off these credit card bills. It's understanding your numbers, understanding where your financial profile is, and putting yourself in a position to start your secure compound interest account now.
This reminds me of like, I will start dieting after I lose weight. I will start exercising after I lose weight.
Right.
And I think somehow like these concepts make sense to us, especially when you're thinking to yourself, like, I don't want to go to the gym looking like this, so I'll go to the gym when I lose a little bit of weight. Like, let me lose weight at home first, and then I'll go to the gym, right? Let me get kind of in better shape at home on my own, then I'll go to the gym. And this is kind of the same theory, is you've got to just get started and you have to build this into your routine. And then the muscles that you build help you burn more calories, right? That's the whole point. This really is no different.
Right.
You get to leverage the work that you've already established to help make it all go faster.
You're absolutely right. If you were to simply put away 10% of your income now, and as you get promotions, as you move up in the company that you're working for, and as you start to make more money, you started learning how to live off 90%. What you do is you carry that 90% into that growth that you're making. So as you get a promotion and you're making more money, keep it at 90%. What just happened? You just increased the amount you're compounding now, which means it helps you get to your goal faster. You have to start somewhere. And again, I always use the term 10%, but maybe it's 5, maybe it's 3. It's starting somewhere.
Yeah, starting somewhere. Mm-hmm. We hope that you all learned something. Thank you so much for tuning in. I think this is a great place to land. Yeah. However, I want to remind everybody that if you are wanting to get started right now learning more, even about MPI, if you want to get started learning more, the reason why everyone ends up poor, you don't want that to be your story. We have 2 free books. Mm-hmm. And we have a video series. There's a webinar. What else is in there? Case studies.
I'm in there.
Yes,
Book
you
some time.
are. He's in there. And we're going to show you exactly how to access that information, and we hope that you will. So you'll know what to do if you've done that, and hopefully you'll join us next time, which will be Sunday. This Sunday and Wednesdays. We're going to do that for
Sunday.
for this next month. And yeah, thanks for joining us, guys. Hold tight 1 second, and I will show you exactly how to, here we go. This will show you exactly how to access that. I'm Angelique.
And I'm Donnell.
All right.
Get self-directed.
Hey, before you go, we want to remind you that becoming fully self-directed means gaining complete control over your wealth, time, and freedom. It's not just an idea. It's a framework, a mindset, and the power to make informed decisions to secure your future. Being here means you're taking those steps, and we want to thank you for allowing us to guide you. We believe that we grow farther and faster when we grow together. So tune in next time and tell a friend to tell a friend. We've helped thousands of people just like you start their journey to financial freedom. And if they can do it, you can too. And if you're ready to learn more, we got you. Get a head start by grabbing these 2 free books. But how do they get them, Donnell?
Head over to my website where you'll have access to a few things. A ton of free resources, case studies, and over 100 5-star reviews from people just like you. And in 15 minutes, we can explore what's possible for you. So don't wait.
Invest in what you want, when you want.
But first, let us help you get
Get self-directed.